Markets go higher and higher and, well, you get the picture. All the while, the bond market's starting to tell us a little bit of a different story, and patience sometimes pays off. Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus, Loftus Wealth Strategies and Wealth and Wisdom TV. Don't forget to subscribe below. Also, show more. We've got links to some information from today's video, my calendar, my email address, etc. if you'd like to send us a question. First up, question from a viewer. Can you explain how you look at use moving averages and what is the invisible moving average? Great question. So, first off, the invisible moving average just means that we're taking out the actual S&P. We want to see price. And that's what moving average, right? 20-day, 30-day, 40-day, 50-day. It's the average price over that period of time. If it's a weekly, 20-week, 30-week, 40-week, same concept. Okay, so it allows us to look at the market. Here you see the daily view, and blue, 20-day, and you can zoom in on the right there, you see it. If it's above the other ones, that is a very good sign, very bullish. Here's a weekly view going back to 0809, and you see what happens when blue goes below. Okay, moving averages dip, okay, and then we've gone up since then. Okay, we had a little bit of a situation 11, and then of course 15, 16 in that period. And then here's what we're looking for, and this came from Weekend Wisdom video, if you haven't watched it yet, on how to prepare and steps to take before we see our next downturn, and I'm looking at the moving averages. So once that 20 goes below, and you can see in this case, it's about 11%, and we went back, we also showed 2000 and some other periods, and that's not a good thing, but obviously most clients will say they're okay with that area. It's when you get the death cross, which is the 50 going over the 200, which I've added. That is not a good thing, and that is a great indicator. So that's how we use them to look at the overall markets. How about the numbers last week? Green across the board. Dow was the big one. 2% for the Dow. Laggarding a little bit, but still green NASDAQ, and then the S&P. Let's go to the big charts. First up, the Dow, obviously having a great week. 53rd all-time high this year. No, it's not yet the #1 in history, but it will be in about 5 more days. So we're looking at here at the bottom, we see that momentum's still pointing up. RSI, relative strength. Yes, when it gets above 70, it's overbought, but if it sustains, that's very bullish, and clearly, not only has it gone above 70, it's gone even higher, one of the highest numbers we've seen since 95. Here is a weekly view just to show how unusual this is, okay? When you go back to 13, we went up 1,000 points. 14, okay, we saw 2, and then we went sideways. Went sideways for 2 years. Then we had the election, we saw our next bump up, and we've had 4,000-point moves this year, and that is a record. So, a little bit concerning because there's no doubt that this market is getting stretched. We're looking at the same thing here in the S&P, where we see overbought conditions, but sustained. Okay, we're seeing a little bit of bounce on the RSI in the bottom, but again, a very good bullish looking chart as we go forward. Now, part of the reason we continue to go up, this is going to show you the Fed balance sheet, and you see the market going with it. You've got low interest rates. We know what's driving this market. Now, it shows you the proposed balance sheet and what's going to be happening. The question is, will the S&P follow? To be determined. NASDAQ kind of been flat the last couple weeks. It already had a nice run up, so it's consolidating a little bit, but definitely has some room to run. From there, market breadth. 200-day moving average, all of them over 70. Strong, again, another good signal. 50-day, same thing. A little bit of a pullback the week before, but then we settled off and it looks strong. So market breadth looks very good. How about the big boys? Institutional money managers actually went down to 65% in equities last week, and that's unusual. I put in a red line there to show you the last time we were there and across the board. So we'll continue to follow that, probably taking some profits. Treasuries, we talked about this in the opening. We hit a low at 2.06. We're now at 2.39, up 0.10 last week. That's a big move. When you look at spreads, a little bit of a bump last week. We were 0.75 up to 0.79. Okay, when you look at Treasury spreads, 10-year minus 2-year. But here's what we're worried about. When you look at this picture, S&P on the top, as yield spreads go lower, you kind of see those tops in the market. So we're going to continue to watch that. We've been here before, but this is the lowest we've been in a while. Okay, I'm looking there to see where this goes. The green line at the middle chart there is basically the 0 line. That's the big concern. And again, if we continue to go lower here, each of the red lines here show recession. So big move here. Let's see what happens. I know we've talked about this in the past. Did not come to fruition, but we'll continue to watch. Sectors. Patience. We talk about patience. Difficult in this business. Here's healthcare. We mentioned we added this at the beginning of the quarter after a bit of a run up, but had a nice little flag there and a breakout last week. So like the way that healthcare set itself up there in a little flag and moving higher. Banks, same thing. We've been in that since last quarter. Had a bit of a consolidation, was worried about resistance, held, and then broke out. Not surprising, at the bottom we're showing correlation, right? If you're correlated, you move together. So in this case, I'm showing the treasuries and banks. One is a 1 correlation, so spot on. Treasury yields go up. Banks are a good place to be, and we see it right now. The other one is small caps. Beginning of the quarter, we added a little bit of small caps to our portfolios, but we said, I expect a consolidation or a pullback because it came off such a big run. That's exactly what we had. There's your bullish flag on the right-hand side, and then a breakout. So really another good sign for the overall markets. Let's look at the data last week. A little bit quiet. Not a lot going on. Housing starts were lower. Building permits were lower. Existing home sales up. And the AAII, individual consumer, not a lot of movement here. Again, I'm still going to call this neutral. You got 37.9 bullish, a little bit less than last week, 34 in a neutral space. Fear and greed, no surprise after that run up. The fear index is up to 90 after getting down to 74 last week. Our signals remain positive. Short-term went positive September the 11th. Long-term, mid-term, still positive. Green. Again, everything right now looks good for the market. It does not say I'm not concerned. I think we're getting really stretched and starting to look at this and maybe just take some profits and in some areas go to the sidelines to the end of the year, but not yet. We'll let you know if we do that. So as always, we appreciate you watching. This is Michael Loftus for Wealth and Wisdom TV.